In 2018, question number 5, it is a 10 marks question for income from house property. What is the question? Sri Nirmal Bosch, who is an assessee, is the owner of 2 houses. Information relating to the 2 houses for the previous year 2021-22 are as follows. In original question, the previous year was 2016-17, but I have changed it into 2021-22 for your relevant previous year. House situated in House 1 situated in Kolkata and House 2 situated in Delhi. That means both the houses are situated in metro city. Used for, in case of House 1, it is a self-residence. It is used for self-residence, and in case of House 2, it is used for tenants' residence. Next information is there, that is actual rent received. In case of House 1, there is no actual rent received because it is a self-residence house. In case of House 2, there is amount of rupees 3 lakhs, which is the actual rent received. Now we have to look whether there is any vacancy period. Yes, there is a vacancy period of 2 months in case of House 2. That means out of 12 months, 2 months is vacant. The house is vacant for 2 months. That means these 3 lakhs actual rent received, this is for 10 months. So for annual rent, we have to convert it into 12 months rent. Next information is net municipal value. Now net municipal value in case of House 1 and House 2, both are in metro cities. For in case of gross municipal value, to calculate gross annual value, we have to convert this into gross municipal value. Which one? The House 2. House 1 is not required for converting net municipal value into gross municipal value. Next information is fair rent for both the house. Interest on loan rupees 35,000 for House 1 for repair and rupees 80,000 for construction. Vacancy period I have already told, and municipal tax is both for 10% is for both the house. In case of House 1, there is no need of computation of municipal tax, but in case of House 2, it is required. Another information is there, that is in case of second house, 20% of municipal tax has not been paid during the previous year 21-22. We know that actual amount of municipal tax paid by the owner is allowed as deduction. That means municipal tax so computed, 80% of that municipal tax will be allowed as deduction. Compute income from house property of Sri Nirmal Bosch for the assessment year 2022-23. This is the question. Now we will do the in case of answer, first we have to write the heading. In heading, first write the name of assessee. Here assessee is Sri Nirmal Bosch. Next, what is the heads of income? Here the heads of income is income from house property. Previous year is 2021-22, which is your relevant previous year. For others, write the relevant previous for you. And assessment year, for your relevant assessment year is 2022-23. In case of others, write your relevant assessment year. There is 2 houses, so we have to draw 3 amount column. I have told you previously. In case of House 1, it is a Kolkata house and it is used as self-residence. You have to write everything, where the house is situated and what is the nature of occupancy. Okay. This is a self-residence house, so annual value is always nil. Here annual value under section 23 subsection 2 for self-residence house is nil. Only one deduction is allowed here, that is interest on loan under section 24 clause B. Actual amount of interest on loan is rupees 35,000 and maximum limit for deduction for self-occupied house, it is this interest on loan is for repairing purpose. So maximum limit of deduction is rupees 30,000. So 30,000 is allowed as deduction from 0. You have to deduct this 30,000, and income from house 1 is negative 30,000. Now come to second house. Second house, house 2, Delhi house. What is the nature of occupancy? It is tenant's residential purpose. Here we have to compute gross annual value in 3 steps. Either we may compute it as a working note, or it may be computed as a part of your sums. In previous sums, I have done it as a working note. In this sums, I have shown you how to compute this gross annual value in the mains question. In step 1, gross municipal value. Yes, you have to first compute this gross municipal value as a workings. Now, gross municipal value of house 2. Now, their net municipal value is given. That is 2,70,000. We have to convert this net municipal value into gross municipal value by multiplying 10 by 9. And another way is 2,70,000 will be added with 1/9 of 2,70,000. It will be rupees 3 lakhs. This is the gross municipal value of house 2. Fair rent is given, that is 3,40,000. Step 2 is reasonable expected rent, which is higher of step 1. Here there is no standard rent. So just you have to compare these gross municipal value and fair rent. Which is higher, it will be taken as reasonable expected rent. This will be compared with the annual rent. Now, annual rent is not given. In question, it is given actual amount of rent received. So, you have to calculate this annual rent. That means 12 months rent of house 2. Now, in the question, 3 lakhs is given as a rent received, and there is a vacancy period of 2 months. That means this rent received is for 10 months. So, for computing 12 months rent, we have to first divide this 3 lakh with 10 to get 1 month's rent, and it will be multiplied by 12 to get annual rent or 12 months period rent, that is rupees 3,60,000. Now, in step 2, we have already computed the reasonable expected rent, and now we have put it this and so we have put this annual rent 3,60,000. Now, in case of step 3, we have to compare these two, that is reasonable expected rent and annual rent of 3,60,000. In case of step 3, higher of step 2, after comparing these two, we get 3,60,000, and from this we have to less loss due to vacancy. We know there is a vacancy period of 2 months. So, how to compute loss due to vacancy? Annual rent is given of rupees 3 lakhs. By dividing it with 10, we will get 1 month's rent. It will come 30,000. And there is a vacancy period of 2 months. Multiplying by 2, it comes rupees 60,000. This is a loss due to vacancy. So, for computing gross annual value, we have to deduct this loss due to vacancy from this higher of step 2, and we get gross annual value as 3,38,400. This is the gross annual value. Here we have to go in next page. So at next page, same format is drawn with 3 amount column. Here first we write the income from house 1, that is negative 30,000, and after that gross annual value of house 2, which was come 3,38,400. From this we have to deduct municipal tax. Now, computation of municipal tax is another workings. Municipal tax of house 2. The house is situated at Delhi. That means Delhi is a metro city and we have to compute municipal tax on net municipal value. And net municipal value is given in the question, that is 2,70,000. 10% of 2,70,000 is 7,000. It is the total municipal tax. But total municipal tax has not been paid by the owner. 80% of the municipal tax has been paid. 20% is due, that is mentioned in the question. So deductible municipal tax of house 2 is 80% of 27,000. It comes 21,600. Now in the question, from net gross annual value, we have to deduct this allowable municipal tax of 21,600. Net annual value comes 3,16,800 after deducting 21,600 from gross annual value of 3,38,400. Only 2 deductions are available. Deduction under section 24. Number A is standard deduction, that is at the rate of 30% of NAV. NAV means this net annual value. So 30% of 3,16,800 is 95,040. And interest on loan is for construction of house is rupees 80,000. In case of let out property, there is no maximum amount of deduction interest on loan. So total interest on loan should be deducted. After adding to this 2 deduction, we came to second column. The total deduction is 1,75,040. And this total deduction is deducted from net annual value. It comes 1,41,760. This is the income from first house and income from second house, and income from first house was negative 30,000. So minus 30,000 and plus 1,41,760. These 30,000 is set off from this income from another house. It comes 1,11,760, which is the income from house property of Mr. Nirmal Bose. In case of question number 5 or there is a conceptual theoretical question in A, that is discuss the deductibility of interest on loan while computing income from house property under the Income Tax Act in the following cases. First case is loan taken by mortgaging the self-residential house utilized for education of child, and number 2 is loan taken by mortgaging the self-residential house utilized for repair of that house. In case of first situation, loan taken by mortgaging the self-residential house utilized for education of child. Utilized for education of child is not allowed. That means if loan is taken and utilized for any other purpose, it will be not allowed as deduction. So in this situation, this amount of interest is not allowed as deduction. This is the answer. What is the answer? Not allowed as deduction. And I have underlined the phrase that is utilized for education of child, which emphasize that this is not allowed as deduction. In second situation, there is a loan taken by mortgaging the self-residential house. I have underlined this phrase, that is self-residential house, utilized for repair of that house. Underline the repair. That means the house is used for self-residential purpose. Therefore, there is a maximum limit of interest on loan deduction, and the loan is taken for repairing purpose. And in this case, allowable deduction under section 24 clause B there is a maximum limit of deduction is rupees 30,000. You have to mention this, in which section it is allowable as deduction and what is the maximum limit. In question number 5 or B, there is another question. It is a missing figure question. What is written here? Sri Kamal Mahapatra is the owner of a let-out house in Kolkata. If during the previous year 2016-17, in case of your previous year, it will be 2021-22. Income of the house is determined as stated below under the Income Tax Act. Then complete the statement. Look at this picture. Here it is not completed. Income from house property is given, but there are some question marks. You have to fill these and compute and show the total statement as an answer. Now, how to do this? First, you have to write the heading. Heading is name of the SSC, previous year and assessment year. I haven't changed the previous year assessment year here. In the question, what is mentioned as previous year or assessment year, I have written here. Okay, only one column is there. What is written? That is gross annual value. Step 1, reasonable expected rent, higher of gross municipal value and fair rent, subject to maximums of standard rent. It is given that gross municipal value is 2,60,000, fair rent is 3 lakh and standard rent is 3,40,000. But what is the reasonable expected rent? It is not given here. So you have to compare this gross municipal value and fair rent. Which is higher? This 3 lakh is higher, and it cannot be exceed standard rent. Here it is not exceed standard rent. So the the reasonable expected rent will be rupees 3 lakh. Reasonable expected rent is rupees 3 lakh. Now, what is rent received is not given. What is gross annual value? That is also not given. Higher of step 1 and step 2, that is not given. Only municipal tax paid is given. That is 10,000. Net annual value is not given. This is also a missing figure. Only there is one deduction is there, that is standard deduction under section 24A at the rate of 30% of NAV. That is also not given. But the income from house property is given here. So, for this, we have to first calculate what will be the net annual value. Now, if 2,45,000 is income from house property and there is a standard deduction of 30% of NAV, that means this is the 100% and 30% is standard deduction. So, this should be 70%. So, we have to make and workings that what will be the net annual value. 2,45,000, this is 70%. So, what is the 100%? After computing this, we get 3,50,000, which is the net annual value here. So, write 3,50,000 as net annual value. Now, what is the what is the standard deduction? 30% of 3,50,000. 30% of 3,50,000 is 1,05,000. Now check it. 3,50,000. If 1,05,000 is deducted from 3,50,000, it comes 2,45,000. Okay. Now we already got that net annual value 3,50,000. Now we have to go this gross annual value. What will be the gross annual value? Gross annual value will be the sum total of net annual value and municipal tax paid. That means gross annual value is 3,60,000. How we got this? After adding this municipal tax with the net annual value. That means it is actually a back calculation. We always deduct municipal tax from gross annual value. Here we have got net annual value and municipal tax paid is given in the question. So to come to gross annual value, we have to add these two, and we got the gross annual value of rupees 3,60,000. Now we already make this computation, that is what is the reasonable expected rent. Only one information is missing now, that is what is the rent receivable or annual rent. Now we know we come to gross annual value after comparing these reasonable expected rent with annual rent or rent receivable. Now here it is 3,60,000. That means here the reasonable expected rent is 3 lakh. So rent receivable should be 3,60,000. That means after comparing these two, it comes gross annual value 3,60,000. This is how to solve this missing figure question.